What if you can get paid just for holding a stock? That's exactly what dividend stocks do. And in this video, I'm going to break down what dividend stocks are, how they work, how you get paid, and what beginners often overlook that could cost you money. And I promise, I'm keeping it simple. No jargon, no fluff. Let's get right into it. Today, we're talking about dividend stocks. If you've ever heard people say, I'm making money passively from dividends, but didn't know how it worked, this is the video you've been waiting for. Let's start from scratch. When you buy a stock, you're buying a tiny piece of that company. For example, if you own Microsoft stock, you technically own a piece of Microsoft. Congratulations, you're a part owner. Now that company makes a lot of profit and doesn't need all that cash for their operations. They decide some of that money back to their shareholders. That's called a dividend. It's basically the company saying, thank you for being an investor and investing in us and believing in us. Here's some cash. And that cash goes straight into your brokerage account. Let's say a company has 1 million shares and decides to pay 1 million in dividends this year. That means every share you own earns $1. If you own 5 shares, you get $5 into your account. Easy math. That's the beauty of dividend stock. You get paid just for holding the stock, whether the price goes up, goes down, or goes sideways. Now here are a few key dates that you need to know to make sure you qualify for the dividend payment. Number 1 is the declaration date. This is when the company announces the dividend. Number 2 is the ex-dividend date. This is the most important date to you. You must own the stock before this date to get the dividend. If you buy the stock after this date, the ex-dividend date, you miss out and you have to wait until the next dividend payment to receive your dividend. And number 3 is the actual payment date. This is when the money actually hits your account. If you miss the ex-dividend date, you're out of luck. No dividend for you. Now this is the dividend yield explained. You'll often see something called the dividend yield when looking at a stock. That's just the annual dividend divided by the stock price. For example, a stock is $100 and the dividend is $4 per year. That's a 4% yield. It's just like getting a 4% interest on your savings account, but with stocks where the price can move up or down. But here's a warning. Just because a stock shows a high yield doesn't mean it's a good thing. Why high dividend yields can be a red flag. If you see a stock with a 20% or 30% dividend yield, be careful. In most cases, that's a sign that the stock has crashed or the dividend might be getting cut. It could also signal that the company is struggling. Remember, if it sounds too good to be true, it probably is. Most companies pay dividends quarterly, every 3 months. Some pay monthly, like real estate investment trusts, REITs, very similar to realty income, ticker symbol O. And others pay annually or truly whenever they feel like it. It's totally up to the company. Now, are dividend stocks right for you? Now, should you only invest in dividend stocks? Not necessarily. Dividend stocks are usually from mature, stable companies, a lot of household companies that you may know, Johnson & Johnson, Pepsi, Clorox, Apple, Tesla, Nvidia, Nike, Disney. A lot of your household commercial companies will pay dividends. They're great for income and they have a lower risk, but they may not give you the explosive growth of newer companies. If your goal is long-term growth, you might lean toward growth stocks. If you want more stability and regular cash flow, dividend stocks can be a solid part of your portfolio. It all depends upon your goals. Now you know exactly what dividend stocks are and how they work. If you found this video helpful, please like and subscribe for more beginner-friendly videos just like this. I'll also start posting my own dividend stock picks, my portfolio updates, and show you how I build passive income step by step. For now, thank you for watching the video. You guys take care.